Hello everybody and welcome to another video on financial analysis of financial statements. And in this video we are going to be looking at Medical Properties Trust. So my name is Ted Wainman and I'm going to take you through the financial statements of MPT, or Medical Properties Trust. So first of all, before we get into their financials, let's find out what they do. These guys they're based in Birmingham, Alabama, not Birmingham, Midlands in the UK. It's a real estate investment trust that invests in healthcare facilities subject to NNN leases. Now, I don't know what NNN leases are, but if you are in the property game, I'm sure that means exactly what it's meant to mean. The company owns properties in the US, Australia, Colombia, Germany, Italy, Portugal, Spain, Switzerland, and the United States. Okay, and really, it's investing in healthcare, so hospitals, for example. So they'll buy and own the hospital and then lease it to the hospital trust, for example, who will then operate in that building. So that's kind of what they do. This is a request from one of our subscribers. So just a reminder, if you do like what you hear, then please don't forget to like, share and subscribe to the channel. And if you are a subscriber, then you will get notification of when one of the companies that you ask us to look at is actually analyzed. I can't guarantee I'm going to do every single one because we do get quite a lot of requests, and there's only so many hours in the day, unfortunately. But this is for Elva Galago, who asked, could we have a look at MPW? So for sure is an interesting company. So let's have a look. And hopefully we got the right company here, MPW. So let's have a look at their financials and find out what is going on in this company. Now, quick caveat, as ever, this is a backward-looking analysis. So we are doing financial analysis. This is the financial statements. This tells us what happened in the past. So we still get comments from some of our viewers saying this is woefully out of date. If you want to leave those comments, you're more than welcome to. Please do be polite in the comment section, but do remember that we are looking at what's happened in the past, and I can only go on the latest set of financial statements. So if the latest set of financial statements were given to me, were published 9 months ago, then it's going to be 9 months out of date. And if you are using this as part of your investment thesis, then don't forget you've got to do a whole lot of other research about the market and the kind of the pipeline of contracts and the new products and developments and the new markets and the management team and a whole wealth of other information that you're going to need to kind of find out before you commit your hard-earned pennies into this stock. However, don't forget, this isn't just for investors. So this is also for people who are interested in just learning more about reading and interpreting financial statements, whether you're in a finance team looking to become an accountant, studying for your CFA, etc., etc., etc. So without further ado, let's jump in and have a look at the financial statements of this company. So here we go. We are looking at Form 10K. This is available on their website, and it has a lot of information in it, but we are interested in the financial performance. And so we have to scroll all the way down to page 61 of 131 in order to find the business. Okay, so here we go. We are looking at the top at the revenues. So here we are, we're on 2020. We are dealing in thousands of dollars. So we're looking at sort of sales of about $1.2 billion, give you an idea of how big this company is. Now, they are giving us a little bit of additional information in terms of their revenue. So they're talking about this rent, which is billed, and then straight line rent. Now, I'm not familiar with the kind of the property world, so I don't know exactly what the difference is between those two. But in effect, what they're just saying is that they got these different rent structures, I guess, and some financing leases as well, etc., etc. Anyway, total income is 1.2 billion. And in terms of the expenses, now I'm just going to scroll up a little bit so we can kind of see this in total. So, it's a slightly different business model because what they, obviously they're buying the building and then renting that building out. And once you've bought the building, you don't really have to spend that much in terms of looking after the building. So, what we can kind of do is to say that, for example, this depreciation and the property related. This is effectively what they're selling. You know, they're buying the building, it's depreciating in value. And so this is the kind of, I've kind of almost classified this as cost of sales. They've got the G&A, which is kind of the overheads. This is the rent. Sorry, this is things like, you know, finance team and HR team, facilities, IT, you know, board of directors, all that kind of stuff. And then the interest. Now, the interest obviously will be a significant cost because, you know, these guys, you know, they need to borrow the money to buy the building, to rent it to the hospital trust, etc., etc. Anyway, what we come down to is kind of so the total expenses are this 749, and then they've got some other income and expenses coming through here, and these are kind of more like one-off, etc., etc. And really, what they're trying to do is to get down to the kind of, you know, the profit down the bottom. So here's the profit right down the bottom, and you can see that they're on sort of 463. Let's just clear that and just scroll down a little bit further, get right down to the very bottom. So here we go. The kind of the net profit is 431. Now, 431 as a percentage of the sales is about 35%, which is pretty high. It was, you know, it's actually over 100% in sort of 3 years ago. So we need to be careful that we're not reading that incorrectly. So, you know, these guys are, you know, they're not selling a product or a service like Coca-Cola. They're selling space effectively, and their aim is to kind of rent the space and make sure that the kind of the rental income exceeds the rental cost, if that makes sense. And the rental cost is kind of interest effectively. And so they are making a profit. Now, this profit, quite interesting, it's bouncing around quite a lot. And, you know, if we look a few years ago, we can see that, you know, they made a big gain on the sale of real estate. So, you know, they'd have had some buildings, they didn't need them anymore, they sold them. You can only do that once, which is why it's kind of below the line, so to speak. It's in the kind of, you know, it's in the other. And they've made a little bit of a profit last year. And then they actually, interesting enough, made a loss on the sale of real estate. So you're not always, you know, property doesn't always go in one direction. They got some real estate impairment charges. That's kind of write-off rather than so the depreciation. It's kind of like another form of depreciation, but it's a kind of I would say a one-off write-off, but you see it happening every single year. Anyway, I guess the point we're making is that, you know, these numbers here are kind of, they're bouncing around a little bit, and they are creating a little bit of distortion in the kind of the smoothness of those earnings. And so it's kind of just to be kind of clear in terms of, you know, what are we actually buying if we're buying into this company or buying into that income stream. So there is the profit and loss account, the income statement. Let's have a look at the balance sheet. So the balance sheet, interesting enough, they kind of don't really talk about current and non-current assets. Okay, so here are the assets, $16.8 billion. And kind of jumping out at us, we see, you know, they've got a little bit of cash sitting on the balance sheet, but most of it is kind of, you know, it's all kind of tied up in their buildings. So here, you know, here's the sort of the big number. It's all tied up in real estate. And then they've got a little bit of cash and a little bit of kind of, you know, rent receivables, which are these two numbers here. So you could argue that these three numbers, this is kind of their current assets, these bits here, and everything else is a kind of a non-current asset. So it's basically, you know, a whole lot of buildings, which you'd kind of expect. We look at the liability side. How did they pay for those buildings? Well, they've kind of paid for them with debt. So there's the debt sitting on their balance sheet. Again, they're not talking about the difference between they're not talking about difference between current and non-current liabilities, and they've got a little bit of accounts payable, which is kind of, you know, they're payable to their suppliers. So you could kind of take those two numbers. The top, you know, the 8.9 billion is the debt, and the 438 is the current liabilities, and liquidity doesn't look an issue from that perspective. Anyway, a pretty healthy, you know, so the equity funding the business, you can kind of see here that, you know, it's about 50-50 debt and equity, which means that the interest isn't too high, which means that they can easily service that interest out of the rent that they're receiving. And so this is a pretty strong business model, so it seems to me. Here's the paid in capital. So lots of paid in capital. What you'll also notice is that, you know, down here, they've got this, the retained earnings is actually a negative number. So it's gone from a positive to a negative. So this is a profitable business, and that tells me that they must be paying out a lot in dividends. So let's go and have a look at the movement in equity, which will tell us if they are paying out dividends. So we just scroll through the income statement. Here's the movement in equity. And so here's a couple of years ago. And what we notice is a couple of years ago, we're really looking at the retained earnings. So there's the profit they make in the year, and they're actually paying out dividends. Now, that was 2 years ago. That was the kind of the 2018, 2019. Again, here's the profit, and here are the dividends. And you'll notice the kind of the dividends actually higher than the profit. And if we just scroll down to the most recent year, again, we can see there is the profit, and there are the dividends. So these guys are big income players, and then what it looks to me like is that their philosophy is all the profits we make, we're going to pay out as a dividend. So there's not a kind of lot of reinvestment going on. They're not holding on to those profits and buying more properties. They're distributing it. So if you're looking for income, then maybe this is an opportunity to buy some of that income. Very, very strong dividend payout, but you're probably not going to get a lot of capital growth on your shares. So, you're not looking for a multi-bagger, the next unicorn, so to speak. Here's cash flow. So cash flow, they are generating cash, which is good. So nice, strong cash flows coming through. Here's the investing activities, and you'll see that in terms of the investing, their investment is, they are buying, additional properties and real estate, etc., etc. And there's a little bit on loans receivable, and then the final bit is on the financing. And you can see in terms of the financing, so proceeds from debt and repayments of debt. So that's the refinancing. So they are growing. They're growing by borrowing money. That's not really a problem for a company because they can afford that debt. There's the dividends being paid out to the shareholders. They're not issuing more shares, so they're not diluting the equity, and their cash looks reasonably healthy at the end of the year. So yeah, so that their cash has gone down, but they're sitting on $500 million in cash, which is fine for the size of this business. So there we have it. It looks a reasonably strong balance sheet. There's nothing kind of no big alarm bells coming out of that. So let's have a look at the share price. So here we see the share price. The market cap is 12 billion. So just so we can understand what that actually means to us, that is, there's a 22 times earnings of PE ratio. So, that's a kind of, if you turn that upside down, you get a yield of about 5%, which doesn't look too bad. It's a kind of a good solid income stream. They've got a dividend yield of 5.5%. Now again, be careful of that dividend yield because it's based on the previous dividend, not the next dividend or the future dividend. We can see that dividend isn't as consistent as it might be, but there's no reason why they shouldn't be able to maintain something in that region. So that's a pretty good income stream, I reckon. So 5% dividend yield, overall yield, is probably just under 5%. 10 times sales. This is, if you're investing in this, you're not investing for capital growth. You're really investing for that income. So if you look at the kind of the trading band from the stock, it's not excessively volatile. Here's the kind of the trading band. So it's been ticking up, which is looking pretty good. There's no reason why it shouldn't carry on kind of going slowly in this direction. So you're going to make a little bit of capital growth, hopefully, or you shouldn't lose too much in your capital growth. But really, this is for, somebody who is, maybe closer to retirement. They're trying to shift out of capital growth into an income stock, and they're looking for something which is, a nice, safe, business. And you think about it, hospitals, healthcare, they're not going to go anywhere. I'm not saying they can't be mismanaged and go bust, but a hospital is a hospital. We're all getting older. We're going to need the healthcare. So this is a sort of slight play on an aging population, etc., etc. So looks a pretty safe income stream to me. And there you go. That's effectively my analysis. So I hope you found that useful. Once again, looking at Medical Properties Trust, nothing very, very exciting, but, a good solid business, a good solid dividend payer, and, really a good opportunity to invest for income. I hope you found that useful. Once again, don't forget to like, share, and subscribe to the channel. If you did find it useful, if you'd like me to have a look at a company, then please do leave a comment in the comments section. If you found it useful, if you know anything else about this company, you want to add your own sort of insights, then again, please do use the comment section to share with us your nuggets of wisdom. And if you want to tell me that this is a backward looking video and that it's nothing about what's going to happen in the future, you'd be absolutely right. Again, you're welcome to leave it in the comment section, but please be polite. And thank you very much indeed for your time. I hope you found it useful. I'll see you on the next video.